So we're doing something we've never had to do before. We are recording a intro after the podcast because of what happened during the podcast. So you'll see later on, we get talking about the dock workers strike, and we literally like put your boxing gloves on. Me, Jay, AJ, not so much Mauricio. We're literally got into yelling and screaming match with each other. We don't want to be fake. We don't want to cut this out. We want you to see how we really are, but we also want people to be prepared for it.
Yeah, I'm not going to say we were totally sober, and I'm not going to say that I actually enjoyed the argument while we were having it, but I think it was necessary. If you like listening to us debate and argue, this may or may not be a treat.
So we're going to put markers on the podcast. If you don't want to hear about the long argument, you could just kind of skip to the end part because it does get a little repetitive. But if you enjoy hearing us yell at each other, swear, I don't know if we call it any names, then you're in for a treat.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, welcome to episode 67 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and I'm joined with the three best friends that anyone could have, starting with AJ Osborne. How's it going, AJ?
Dude, I'm doing good. Doing really good, man. Got my Diet Coke and my red cup ready to go. Great topics today.
Awesome. Jay, how's it going?
I like how when you're introducing your best friends, I come second. When it's just the regular podcast, I come first. But I get it. It's okay. I'm doing well.
Take a hint, please.
I take a hint. I'm doing well. Got my Costco circumference cab, and still got like 6 bottles left.
Nice. Mauricio, what about you, man? Little ginger piss?
Nope. Not only are you guys my best friends, you guys are my only friends. I'm excited to talk to you guys. I'm pumped that Christmas season is upon us. October has begun. And I'm really pumped because I won both fantasy football league games this week, both the Drunk Real Estate League and the regular. I'm just crushing it. I'm unstoppable right now. And as a result, I'm drinking the Napa Quilt Reserve Cab, which is absolutely delicious. Highly recommend it. And don't drink whatever Jay's drinking from Costco. Drink the real stuff, like the Quilt Cab Reserve.
That looks good. I'm not going to lie.
Yeah, I think 500 is pushing it for crushing it. But yeah, you're doing all right in our fantasy football league. Yeah, we are actually recording a doubleheader because we're in Cancun next week. So we're going to record a little bit after this. So I knew it was going to be a long one. So I'm bringing out my Monster. AJ will appreciate this. The Monster Ultra. It's the white one though. I think AJ had the blue one last time. And then I need some alcohol to mix it in. I was like, what's like a low carb, like no carb, no sugar alcohol that's really great for mixing. And so I actually, this was just sitting on my desk again. So I'm going to mix it with a little bit of clear rum. No carbs, no sugar. Awesome. All right. We ready to get into this?
Let's do it.
So while over here in America, all we worry about is inflation, but across the pond, our economic rivals are in a quite different situation. Beijing just announced that its biggest stimulus since the pandemic was on its way in a bid to pull the world's second largest economy out of deflation. So the broader than expected package offers more funding and interest rate cuts. Since 2017, we've seen foreign investment in American real estate steadily decline. So, Mauricio, is this stimulus something that's going to jumpstart the influx of foreign investment in America?
I don't know. I really wanted to do this topic just because I just really wanted to highlight the fact that, we always look from the real estate standpoint. We're always looking at our domestic, supply and demand. And we often forget that we live in a very interwoven world, international world, where things that are happening across the pond or across the other side of the world does have an effect on us. That's really what I wanted to do. So I want to do a little bit of a deep dive into it. Then I got a little bit disappointed in it. And then you guys told me you guys are pumped to speak about it. So let's get into it. So China stimulated about a week ago. And when I say stimulated, they kind of opened up the floodgates. They've been a little bit resistant over the last, really honestly, since COVID. They took a really hard hit. They responded a little bit harsher than most on COVID. Their economy's been struggling for the last 4 years. And finally, they've kind of unloaded some of these stimulus. And it's some of it are similar to the things we do here in the United States. Some are different, but just to rattle off a couple things so you guys have an idea. They cut their sort of the People's Bank of China, PBMOC, they cut their interest rate. They use the reverse repo as their kind of equivalent of our Fed funds rate. That's really their main tool that they use. They cut that by 20 basis points. They cut the reserve requirement that the banks needed, and they cut that by 50 basis points, which is actually a pretty big jump compared to where it is now. They're actually anticipating that's going to probably release about 1 trillion yuan into the economy, which is about $142 billion. They cut mortgage rates by 50 basis points. Again, they control everything. So they cut basis point. They had a requirement or a restriction on second homes that you had to put down 25% as a down payment. They reduced that to 15%. And what I thought was hilarious was they actually started giving some lending facilities and some loans to banks and some funds and some players so they could basically go buy stocks in the stock market. It was almost like a direct stimulus to the stock market. So there's these loans, about 300 billion in loans where companies can literally buy back their stock with these loans that they get. So bottom line is it's just a huge stimulus that was unleashed about a week ago. Markets in China anyway, and all that responded very favorable. I literally own one Chinese stock, and that's gone through the roof over the last 4 or 5 days.
Or what is it, Mauricio? Let us know.
Alibaba, baby. But I bought Alibaba a while ago. It's just been in the crapper since COVID and all of these stocks now. I think the stock market literally went parabolic the day the stuff released. But what was interesting to me,
did you cash them out, or you're riding the wave?
I think I'm riding the wave. I mean, it's already there. I mean, I wouldn't buy it if I was not in it, but since I'm in it, I might just stick around for a little bit. It just keeps going up and up and up. So I don't know. We'll stick around. It's still pretty low from a PE, especially a forward PE ratio. But anyway, I digress. So then I dug in a little bit about, how does the Chinese economy as a whole or Chinese investors affect U.S. real estate, and pulled up some interesting statistics. According to the NAR, the National Association of Realtors, China is the leading source of foreign investments in U.S. real estate, which I thought was really interesting. Right before COVID, it really peaked. It was at about $11 billion, which is about 1/6 of the foreign investment, which you could argue, and I'm sure Jay was probably, I'll preempt his argument that it's probably not a huge number if you look at the overall residential real estate market, but it tends to be pretty concentrated. So the Chinese don't buy real estate in, Boise, Idaho, or, Philadelphia. They tend to concentrate in certain markets like California, Texas, Florida, New York, because that's where they want to live. That's where they want second homes. That's where they want to go to universities. So there's been sort of an influx of capital in those particular markets. The Federal Bank of Boston does a lot of research on this, and they were talking about how back in the last big recession, 2008, there was a ton of Chinese investment coming into California, and a lot of the increase in prices in California from 2008 to 2015 was due in great part to the Chinese income. So there's definitely some effect from China's investment. I'm talking about investors. I'm not talking about the banks. I'm not talking about foreign funds or anything. I'm literally talking about Chinese investors. And I guess you've got to think through whether you believe the stimulus is a good thing or a bad thing for China, right? Because one argument could be made that, man, this stimulus really shows you that the Chinese economy is in the toilet. Like, they're really struggling. It's in bad shape. And that really necessitated China to unleash the stimulus. That's one way to look at it. The other way to look at it is no, the Chinese just unleashed this huge stimulus that's going to really prop up the Chinese economy, and it's just going to boom, and whatever effect it's going to have effect. So if the economy in China does well, I think I would argue that the risk of some Chinese capital leaving the U.S., if times are tough, there's a chance that, Chinese investors liquidate their U.S. investments to cover their losses or cover their issues in China. If you think that China, this is going to be the recovery and it's a good thing for China, then obviously that reduces the risk of flight. But I actually think it affects more on the commercial side than residential. Like, for example, what's one of the biggest things that commercial real estate really depends on is obviously interest rates, right? Mortgage rates, which are really depend a little bit more on the 10-year note, right? For the 10-year interest rate to go down, that means there's got to be a demand for 10-year notes, right? There's got to be an increased demand. And remember, treasuries is a global market. So the more demand for 10-year treasuries, the lower the interest rate. And the argument could be made that, hey, if this really does free up all this liquidity, especially for the wealthy Chinese, that they're going to start parking more money in U.S. Treasuries, which would then increase demand for treasuries, which would decrease the yield. And as we also know, a lot of the commercial real estate does depend more on foreign investors. So whether it's REITs, whether it's mortgage-backed securities, I mean, the international market does affect commercial real estate a little bit more. But I don't know. I was kind of up in the air whether this really was going to have a huge impact on real estate. I don't think on the residential side it's going to be that much. I mean, let's face it, it's not a huge amount of money, even in concentrations like California. But on the commercial side, I think there is some potential for. Again, it depends on how this ends up, Dean. I don't have a crystal ball. I've read from, and I'm by no means a Chinese expert, but I've read both sides of the aisle where they think, on the one hand, this is not going to help the Chinese economy that much. The stimulus is just going to wear off here pretty soon, and we're going to reveal that Chinese economy is not in great shape. I've seen a lot of reports on their GDP targets that probably aren't going to get hit. I think they're aiming for about 5% GDP growth, that those aren't going to get hit. So I don't know. It depends on really whether it's going to have an impact or not, but interesting to see whether it affects the commercial or the real estate more.
China's in a real estate crisis. So 27% of China's entire GDP is in real estate. So they have, in China, it is very much a cultural thing to create wealth through home ownership because they don't have other means. It being a communist country, there's very little. And so as China grew and expanded, the investment into real estate in China was astronomical. It once again made up 30% of its GDP. And that bubble burst, right, a few years ago. Interest rates went sky high. The largest developer in China, one of the largest in the world, went bankrupt. And they have so much supply due to their dropping fertility rate, and it's not getting bought up. They're now just bulldozing cities and houses because it was all spec. So Chinese, it was spec tied to debt. Literally, we're looking at it was 2008 just in China. And the stimulus that came through China's growth after 2008 was huge. So their debt to GDP is massive. They've taken on so much, and they continue to. And so this latest round is trying to spark that again. But let me share a screen. I can show you a few things on their average consumption and things that have been going down. And one of the things that people were afraid of or nervous about was that this was going to spill over into the United States overall debt mark. But the housing market boom and bust that has happened, right? It just hasn't recovered. Their overall debt to GDP has and continues to soar. But when you look at their declining fertility rate, there's nothing that has been really supporting it. And that really has a lot to do with their housing consumption, which is huge. And this has resulted in a mass unemployment, particularly within the youth. Over 20%. Employment is really, really bad there right now. So there's nobody there to buy, right, these homes. This has then resulted in consumption. And the consumption rates that we've seen in China, right, is dropping, while simultaneously we have the government, which is picking up more and more share of it. And so it's like the government is trying to bridge these things. We also have manufacturing moving over. Those are all just slaughtering the housing market in China. And that's not something I think that they can fix easy. And everyone's worried that
they're trying everything they can, right? Like they got a little cocky and they blocked foreign investments in real estate and foreign investments, all these different things. Now those are opened up. They're basically taking all the restrictions. Like it used to be oh, foreigners aren't allowed in any of this. Now they're please come give us as much money as you can. So they're really trying to do everything they can to get money coming into it.
Yeah, I think it all boils down to, and AJ hit on this, and I do want to share the screen again just to kind of put a finer point on it. But if you look at China's debt to GDP, what you'll see is that it was relatively stable through about 2015, 16, and then even before COVID, kind of started to go through the roof. And they're somewhere around 80% of their GDP in terms of total debt. Now, the U.S. is about double that. So you could say, oh, they're not in that bad a shape. But keep in mind that while China does trade in its own currency locally, and they have their own central bank, and they're pretty self-reliant there. The bulk of their central bank currency is denominated; they're pegged to the dollar, and so they don't have the luxury like the U.S. does of just printing as much money as they want and controlling their interest rates 100%. They do have some control, but as Mauricio said, they don't have like a federal funds rate. They have internal lending rates. And so the big issue that China is facing right now is basically the same issue that the U.S. is facing, but to a greater degree. They've got too much debt. And it's the same issue that Japan saw in the late 80s. They had too much debt. And the question is China going to deal with that debt in a way that's going to allow them to deleverage their economy, to basically get rid of this debt without destroying their economy? And so you look back at what Japan did in the late 80s and the 90s, and they did things completely wrong. So basically they had this deflationary pressure. They were starting to see less money being spent because they had an aging population. They had an economy that was faltering, and they had this deflation. And so the way they handled the deflation was they printed a lot of money. It was a lot of stimulus. They went to negative interest rates. And while all those things are important, they missed the single most important part of the equation. And I steal this from Ray Dalio, who has written books upon books upon books on this. But he actually has a term for it called the beautiful deleveraging. And the beautiful deleveraging is basically this concept that Dalio came up with, where you can take all of this debt. And this is important. And the reason why I'm familiar with this concept is because I really think the U.S. is going to deal with this in the next decade or two. But this idea of a beautiful deleveraging kind of combines two things. One, it requires this inflationary pressure through stimulus. So the same thing that China's doing, the same thing that Japan did, the same thing the U.S. is doing right now, basically printing money so that they can prop up their economy, lowering interest rates, quantitative easing, basically all these things that are inflationary. But you don't want runaway inflation, so you have to do something that's also deflationary to kind of cancel that out. And what Dalio suggests that has been done a lot of times in history is you have to restructure all that debt that the government has, that businesses have, that consumers have, and you need to restructure that debt in a way that's deflationary. And that cancels out the stimulus. And if you can get rid of the debt at the same time, while you're stimulating the economy and keeping the deflation from happening, you can basically, in theory, get this really nice soft landing. And so Japan didn't do it in the 90s because they didn't restructure any of the debt. They stayed super leveraged. Banks were leveraged. Governments were leveraged. Consumers were leveraged. And so you basically just had this deflationary spiral. But what Dalio suggests is if you can restructure all of that debt, basically make that debt go away or extend it or renegotiate the debt, you basically get the deflationary canceling out the stimulus and the inflationary. You get rid of the debt, you get a soft landing for the economy. And so obviously, it's not all good news. The bad news is when you restructure debt, somebody loses. There's going to be a transfer of wealth. And maybe that transfer of wealth is if governments restructure their debt, like local governments or state governments, if we did this in the U.S., were to restructure their debt, the bondholders, the investors that hold local government bonds or state government bonds are going to get screwed. If banks restructure their debt, the banks might get screwed. People are going to get screwed through this restructuring. But at the end of the day, if you do it right, you can save the economy. And I think China is going to be a really good example for what the U.S. is eventually going to have to face. And I think if China can get it right, it'll be a good omen for whether the U.S. can potentially get it right when we have to face it in the next who knows how long.
But in general, everyone thinks this is a good thing, right? Like what they're doing, they like this plan. Like their stock market ripped after this announcement. Even foreign stock markets, like the European countries that all deal a lot with China with their, car imports and mining and luxury goods and stuff like that. Those all ripped. And one of the weirdest things I thought from this is China announces that they're going to be printing money and the value of the yuan went up somehow. So that obviously must be an indication that everyone thinks this is going to make their economy head the other direction. So
in the short term, it always does. In the short term, government spending always props it. The problem, though, that China has is the debt to GDP is one thing, but the GDP quality is not the same. So the debt to GDP, when you look at a country like China, for example, the amount of it is not equal in terms of quality as it is in other countries. So when you have China, its ability to pay off and people's beliefs in its ability to actually pay it off, right, is going to vary wildly how much it cost and how much the debt cost, right? China's currency is only 2% of the entire world's currency. It has all sorts of rules, sanctions. It's part of the BRICS. It has close ties with Russia. It is not a stable economy. It is, it has a whole lot of other things going on to where people are much more weary of it. So it is much more susceptible to debt than a lot of other countries might be, and especially when you're dealing with like European countries and things like that. It's not a first world country. So that makes their debt issue even harder. They have way higher rates. Their mortgage rates and everything went up to 23%. It's that impact on that debt is not the same when your debt costs 2%, right?
Yeah, but at the same time, they just announced that they are going to forgive and restructure a lot of that mortgage debt for their citizens. And so I think they recognize, again, this need to restructure as well as stimulate.
But I'm talking about the government's debt and what the municipalities use and everything else use, right? It's contingent. So the individual consumer restructuring, that has to happen because they're choking out their consumer base. But that amount of debt the government's taking on and how that trickles down to these large developers and what happens in their bond market, right? That stuff, people get spooked, and that changes rapidly. And China's very susceptible to that. And therefore, its real estate markets are.
I mean, you guys are bringing up some good points, but you guys are kind of skirting the main question that I was trying to answer, which is, what does all this have to do with the U.S. and does it impact the U.S. economy at large?
Well, let's do a thought experiment then. Let's assume that this is a good thing, and that China's going to have a better economy. They're going to see growth, and that they're going to have more money to invest. So we just kind of debated whether or not this is a good thing. Let's just put on the hat saying, okay, this is a good thing. Things are going to get better for China. And to Mauricio's point, is this going to affect foreign investment into American real estate? That's what you're going to have.
Yeah, you guys just brought up an interesting thing that I left out before, which is, yes, the yuan, for example, has strengthened against the dollar. It's now, I think, at a 16-month high, right after the thing, which means U.S. real estate for Chinese investors is cheaper now. So I don't know what the percentage change has been over the last week, but U.S. real estate is cheaper. And if the yuan continues to appreciate, assuming things are going great and that trend continues, that means real estate prices, all things being equal, will become cheaper and cheaper for a Chinese investor, which would lend to the argument that there'll be some additional demand from not only Chinese investors, but all the other surrounding companies. So that was one argument in favor of this being positive for either residential real estate or maybe at a broader sense.
Can I put some numbers on that too a little bit? Because there is a bit, you touched on this in your intro, there is a big difference between residential real estate and commercial real estate when it comes to foreign investment. And because foreign investment, it's like non-Americans owning actual homes, the percentage is only somewhere like between 2 and 3% of homes are owned by foreigners. And that's just so it's even smaller when you just talk about Chinese. But when you get to commercial real estate owned, that number is typically be between 10 and 11%. But I think what you were getting at is since 2017, that's steadily been coming down. And since the pandemic, we're down to now it's like only 6% of commercial real estate as of 2024 is owned by foreign investors. So whether it's kind of just a combination of all different things with just commercial real estate values going down and foreign investors pulling out, or, they're to this point, China's economy just hasn't been doing well, so they don't have the same amount of money to invest in us,
And well, don't forget there's COVID too, right? So COVID, I mean, their economy essentially shut down. They didn't have there was no Chinese investors coming over to the United States to check out property. So just that naturally, there's definitely a natural drop from 2020 to 2023, 2024, and now it's kind of coming back. But yeah, I mean, and don't forget, the derivatives market. I mean, when you guys go get loans on your multifamily properties, those are all eventually going to be, your loans are going to be shopped out and turned into mortgage-backed securities, and they're going to be purchased by investors. And a lot of those investors are foreign investors. So the more demand for those will create a lower, a lower yield for that as well. So
I think they are spooked though too, because it's like if you look at the foreign investment concentration, it was a lot higher in like office, and obviously office has not done well. Not that other commercial real estate assets have done great, but office is obviously the poster child for a correction is a good word to say it. And so now foreign investment, if you look at the foreign investment, it's all going into like data centers, life sciences, a little bit in apartments, student housing, stuff like that. But like $0 basically going into offices because it looks like foreigners are spooked based off of that.
Well, and don't forget office is unique too, because they're not only investing as just as an investment, but they have companies that actually need offices. Like they have companies here in the US that need an office to work. And so that's one of the reasons you see those numbers a little higher.
I think this is a bigger issue than you guys are making it, because I think at the end of the day, what's going to impact real estate values in the U.S. the most is the U.S. economy, the broader U.S. economy. And what's going to impact the broader U.S. economy? Well, the global economy and how well China's doing. I mean, think about we get over $500 billion a year in negative trade with China. We're importing a lot of stuff. And if their economy implodes, if they have trouble continuing to manufacture, or if they see inflation and prices go up, potentially that impacts our economy. That impacts the people.
So wouldn't inflation be worse for us than like if their economy implodes, like that wouldn't lead to, would that lead to higher prices for us? Like,
so look at what happened with Japan. So you're a baby, you don't remember this, but Mauricio and I are old enough to remember back when, before China, like Japan was our big trading partner. Japan is where, like in the 80s, we used to get all our stuff. Everybody would talk about like Japan was the future, and all the talk about, are we relying too much on China these days? That used to be Japan. And then Japan went through basically this deflationary period where their economy imploded and all their workers ended up getting old and they didn't have a high enough birth rate. And what happened? We stopped trading with Japan because they couldn't meet our needs. And luckily China emerged, and that's been kind of a saving grace for us for the last 20 years in terms of commodity import. But if China sees the same thing, who's going to take over for them potentially if they implode and their economy can't?
Mexico.
Yeah, Mexico. They are actually our largest trading partner. China represents 17% of all our imports.
Yeah, but it's different types of goods. And I'm not saying Mexico is a really important trading partner, but from a commodity standpoint.
You mean we get more things than avocados from Mexico? Like,
we do. We get a lot of food from Mexico. We get a lot of.
Dude, you can get avocados from I live right next to Fallbrook, which I believe is like the avocado capital of the world or something. But anyway.
Yeah. So I was just going to say that if China goes down the tubes, basically all that stuff you see at Walmart could disappear. It could go up in price, and a large section of our economy, including me who shops at Costco, relies on being able to get cheap stuff from China.
so Mauricio, are you going to try and bring this back to real estate again, or is it?
Well, that was a whole thought experiment. I mean, that when I saw this China news, that's kind of where I went. I mean, yeah, I did look at my Alibaba stock to make sure it was going up, but other than that, I mean, that's really what I was more interested in seeing. I wasn't trying to force the issue. I was just really trying to figure out, will it have an impact? Because again, most people think of real estate locally. Same thing with the treasury market. I kind of want to go on that horse a little bit because most people think the Fed somehow controls, or that's the main driver of the 10-year treasury, which is very closely tied to mortgage rates. But the treasury market is the deepest, most liquid, most international, market in the world. And so a lot of that demand and supply and price movement happens internationally. It's not just the Fed.
Yeah. Okay. I think it's a debate though. Like we've had this debate before, but I'll bring it up again. I think it's debate how when you say doesn't have effect, like the Fed does though, and how much of it is the Fed affecting, and how much is in the foreign investments and other people who are buying the treasuries. And I'll just point back to every time the Fed makes a drastic move or Powell does a crazy speech or does something like that, there's massive swings in the treasuries. So to say that the Fed's not the one setting the treasury markets, yes, there's other factors. But if the Fed came out tomorrow and
I will challenge you on that one. I've seen graphs before that graph the Fed funds rate movement with the treasury movement, and that they're not necessarily very tied together.
So okay, I'll pose this to you then. So if the Fed came out, so Powell came out and called an emergency meeting tomorrow and said, hey, we need to drop our rates down to 2%. We're dropping right now all the way down to 2%. You're telling me that the 10-year treasury wouldn't all of a sudden plummet?
But not by 300 basis points.
Well, it wouldn't be a direct one, but it would be pretty close.
Sure, in the short term, for sure, yeah.
The 10-year treasury would go down at least 1.5 points. I'm saying maybe even 2 if they said that. So, like, yes, foreign investment and people buying treasuries do affect it, but I don't think you can downplay the Fed's effect.
I don't know. I'll pull the graph. I mean, even I remember in 2008, I saw the graph when even in COVID, when things went down to zero, you don't see a direct correlation on the 10-year. So I'll pull that graph for next time, since I'm.
And let me tie this back before we move on. I don't know if we're getting ready to move on, but let me tie this back to a previous episode where we talked about this thing called the yen carry trade unwind. Basically, the fact that Japanese investors were taking out loans at really low interest rates in Japan, and they were taking that money and investing it in the U.S. And then as Japan started to raise their interest rates, they started to pull that money out of U.S. assets and put it back in and repay it in Japan or put it into Japanese assets. Well, we have a potential here, and I don't know how this is going to go because we have two competing factors. One, we have China lowering its interest rate, its core interest rates. And so that means that there's a bigger disparity between Chinese interest rates and U.S. interest rates, and Chinese interest rates and U.S. asset returns. And so it's possible that we're going to see a lot of Chinese investors start to borrow lots of money from Chinese banks because it's really cheap now, and start to put it into U.S. assets, in which case we see U.S. assets going up in value. But there's also another possibility, and that's if the Nikkei stock market, if the stock exchange starts to rally and hard assets and businesses in China start to rally, who knows? Maybe Chinese investors are going to start pulling money out of U.S. assets to invest in Chinese assets because they're doing so well because the economy is back on track. And so I'm not smart enough to know which direction that's going to go, but it just feels like one or the other could happen depending on what the trajectory of China's economy over the next 6 or 12 months.
Yeah, and Kyle, I just if you want to just really quickly here, just for shits and giggles, but I mean, I found there's one. I don't know if this is the actual one, but if you can see here, this is the overlay of the 10-year Treasury with the Fed funds rate, and yeah, I mean, you can see even in 2000, you see the drop when it goes basically down to zeros. You know, yes, the 10-year does drop a little bit, but if you notice, sort of the trend continues to kind of go in the same direction it was.
Yeah, I'm not arguing that it's there's not a other factors, and I'm just saying they do affect each other. That what the Fed says and does is going to have a direct correlation with what happens with the 10-year Treasury, and it's I think it's debatable which lever has more pull on the 10-year Treasury, whether it's the Fed or outside factors. As of midnight this morning, 45,000 dock workers down the East Coast went on strike, halting half the nation's ocean shipping. So this is the first large-scale strike of dock workers in nearly 50 years. So analysts are estimating this is costing the economy billions, that's with a B, of dollars a day. And of course, there are calls for massive inflation coming if this persists. So while it seems like a big deal, President Biden has already come out and said he's not going to use his federal powers to end the strike, which I don't know. To me, that's a debate right there, whether or not he should be doing that. So Jay, how big of a deal is this for us as investors and just us as Americans?
Wait, I'm sorry. Before you started, did President Biden make an appearance somewhere? Is he still around? It felt so like, wait a minute, Biden's still around? Is he still in charge? Is he still part of it?
I think this was like he was talking about something different, and like they asked him about it, and he was like, "No, we're not going to do it." And like he was kind of like a passive thing, and then we're like, "This is kind of a big deal," you know.
Okay, my turn.
You got 2 minutes to do your turn, Jay.
My turn. You and AJ at the start of last segment, Mauricio and I had to wait 10 minutes each for us to get a word in. And now it's your turn.
Okay, so yeah, this is the first strike that these guys have had, guys and gals, I'm sure, in 50 years. And that's because 50 years ago, they negotiated a pretty good deal where they got basically guaranteed salary, guaranteed income, whether they were working or not. Now, let's be clear. These dock workers, they work hard. They work a lot of overtime. The economy really relies on them. It's dangerous work. But they've done a really good job of not negotiating through their union for like the last 50 years. At least the East Coast guys haven't. And so today they are. And so they're basically asking for two things. One, they want better pay, better benefits. So let's start there. Basically, they've had a contract for the last 6 years. That contract has gotten them about an 11% raise over the last 6 years. Inflation over the last 6 years has gone up about 20-some%. So they've lost money to inflation over the last 6 years based on their previous negotiation of the contract that's currently in play, getting ready to expire. So they're basically asking for average pay right now is about $39 an hour for these guys. They want $5 an hour increase per year for the last 6 years that they've been losing out to inflation. So they want another $30 an hour or $69 an hour at this point in the new negotiation.
So they asked for, just to clarify that, they asked for 77% increase over the next 6 years, correct?
Yeah, that's a 77. So 39 to 69, 77% increase. And they're also asking for some additional benefits. They're asking for some additional pension stuff there. And their argument is, and I'm not going to take sides here. Maybe I will, but their argument here is that they worked during COVID. A lot of them got sick. A lot of them died. A lot of their family members got sick and died, but they basically kept the economy going more so than probably anybody in this country. The shipping companies, the ones that pay their salary, so the ones that they actually are negotiating against and the ones that pay them, they made record profits back in 2021, 2022, 2023, billions of dollars. And because the dock workers had this guaranteed contract for 6 years, they couldn't negotiate any higher rates despite high inflation, despite the fact that the shipping companies were pulling in billions of dollars. And so their thought is, well, we lost out on a lot over the last few years. We've put in a lot over the last few years. And now we want to get compensated in retrospect for everything that's happened over the last 6 years that we didn't get compensated for. So that's number one.
Even though we agreed on something else, correct?
They did. But that's the thing. They didn't try and renegotiate for the last 6 years. They didn't say we deserve more. But what they're saying is now we're going to negotiate. It's now time to negotiate again.
In retrospect, not just moving forward.
Right.
No. Just moving forward. They're not getting paid retro.
No, they're not getting paid, but they want to make up for it. They want a 77% increase over the next 6 years. Like they're not saying, oh, inflation's going to go up 77% over the next 6 years.
No, we want to make up for what happened.
Exactly. So you are right, AJ.
Kyle, you played professional hockey. Let's say you negotiated your first year, you had negotiated a contract for $500,000. And
no, Jay, I'm glad you brought this up. I will tell you how this works. So people will probably argue against me with the NFL because NFL contracts get restructured all the time. NFL does not have guaranteed contracts. NHL does. So if I sign an NHL contract and I sign a 6-year contract, $1 million per year, right? And then after the second year, I'm third in the league in scoring, right? The comparable people who are top 3 in the league in scoring are making $10 million. I cannot go back and say, hey, I'm doing better than what we negotiated in my guaranteed contract. You got to start paying me $10 million. No, I got another 4 years.
Exactly. That's my point. So what are you going to do at the end of that 4 years? Are you going to say, I want my 10 million? Are you going to say, you just got 6 years of the greatest player in the league, basically working for $1 million. I'm negotiating hard because
All right, I get what you're saying, but I'll take the other side of that. Okay, so that's year 2. I'm third in the league in scoring. Then year 3, I'm 10th in the league in scoring. Year 4, I'm 20th. Year 5, all of a sudden, I'm middle of the pack. I'm a third, fourth liner. And then by the 6th year, I'm barely on the team. Like I'm barely as good to be on the team. When I have to go and get a new contract, are they going to go say, hey, you had a great second, third, and fourth year. You should have been making $10 million. We're going to sign you to a new contract and we're going to pay you $3-4 million, even though your market salary, if you were to be a free agent and go somewhere else, would be $500,000. Are they going to go do that?
No, but I would argue that these dock workers are just as good in year 6 as they were in year 1. They
you go for what your market value is when your contract expires. That's what I'm saying. The market value determines what your pay should be.
You don't get to go hindsight and say, but I did X and X and X, because we get to do that to our investors? Go back and say this project was way harder than we anticipated, and so.
If that company lost money, Jay, if the company lost money or there was deflation, are they going to renegotiate a contract and say, hey, we're going to negotiate a 13% decrease over the next 6 years?
So let's say the company puts in, and this dovetails into my second point. Let's say the company says we're going to automate, and we're going to automate a lot of your jobs away. Should they be forced to keep those people, or can they fire them?
Fire
them. Exactly. So if they can automate their jobs away, they can fire them. Basically, they can negotiate anything they want. There's nothing that says.
But they can't. See, here's what gets me with this whole thing. We, like the FTC, right? They're like, one of their primary jobs is to prevent monopolies and all these, and they're all over the tech industry. We don't want monopolies. It creates bad business. It's basically un-American. There's no competition. How do we get to this point where all of a sudden it basically sounds like we have 2 monopolies fighting against each other, right? Like we have one side with the business that is controlling 2/3 of our sea imports, and then we have a union that's controlling 100% of the workers working in that industry. So how do we get to this point where basically we have 2 monopolies on something fighting against each other? Because it just creates this like normally I don't want the government to step in, but like when they said Biden's like, I'm not going to step in on this, I'm like, this is the most convoluted situation we've ever seen, and the people who are losing are going to be the American people, because we've allowed 2 monopolies to all of a sudden just go at it.
I disagree that these workers are considered a monopoly. These workers could get fired tomorrow and replaced with other workers. There's nothing stopping.
They're going to all of a sudden hire 45,000 people, Jay? That's how unions work.
No, Kyle, not even that. They are protected. These are a protected class of employees. They cannot just go in and fire them.
They can't fire them for striking. They can fire them if they find lower cost employees. There's nothing protecting them from being replaced by somebody that does the job better, or somebody that does the job.
But there would have to be another union member, though. They can't be a non-union member. Look, let me give you the example here, because here's the issue. I'm probably the only one that's sitting here that's actually dealt with the ILA, because in my former life I was a maritime attorney representing these ship owners. So I dealt with I dealt with these longshore association unions all the time. And on the one hand, it's like there's pros and cons, right? On the one hand, obviously they're very needed. It's a very dangerous job, especially some of these crane operators and people who are actually taking those cranes off the ships. But it is such an inefficient system that it increases the cost of all of these goods that are coming in. I'll give you a great example. Because of my bilingualness, I used to handle a lot of the stowaways. So when they found a stowaway, meaning somebody who'd come on a ship in Asia, whatever, from China or Central America, whatever, and they came illegally on the ship trying to get on the U.S., our firm would be hired to go handle them. And one of the things we had to do was get security, because I had a stowaway in a cabin. We had to get private security to make sure the guy didn't run away and run off the ship and run into the port. Even though we wanted to hire our security guys with guns and properly trained, the ILA, the Longshore Association, did not allow us to do that without having at least one of their persons there as well. So we had to basically have to shadow them. Basically, we had our own security person and we had somebody from the union also being there. And that person, I remember vividly, was like this 80-year-old grandmother who was just sitting there outside of the cabin. And that was the official union representative while we had actual real security with armed guards and stuff like that. So it's a very inefficient system. And it's such a powerful union that you can't do much in terms of replacing them or if you don't like the way they're working or do whatever, you have no control over that. And they cannot get fired and replaced by a private security person. They have to have, and they demand that they have that and that's part of the agreement. They're going to have somebody.
I've worked with unions in every industry that we've consulted on, negotiated, and worked with, in not every industry, but most industries, everything from mining to public servants to everything else. The HRs and the controllers, they cannot just go fire and hire Joe Blow off the street. That's because
that was part of the negotiation.
But that's the contract they're in.
That was agreed to by both sides.
Exactly. So your argument of, well, they can just fire them, that's not true. So the idea that they are a monopoly is
the contract is being renegotiated right now. They're in collective bargaining right now. They can renegotiate. They can say we refuse to give.
This isn't like a normal negotiation where we're like we go back to the auto workers strike, right? Like all of a sudden Ford, the auto workers decide to go on a strike. Like that's not like a monopoly that we're talking about like right now. All of a sudden Ford can't make cars. Mauricio could still go buy his Mercedes. Like it's still it's not the American people that are getting fucked right in that case. Right now, basically we've created this. It is so like detrimental to the economy that like it does affect us, and they have so much power to sit this out because they know that like they have to blink. They have to. Like we can't tank the economy just because over like a 77% increase on their wages. They have us by the ball.
They were offered a 50% increase. They were offered a 50% increase, and they literally told them to stuff it. And two, if you've ever worked with unions and negotiated, this is how it works. They will not even talk because they don't have to. And do you know how many times we were told, not only are you not going to touch that or the salaries or anything else, we're not even going to talk to you. We won't even come to the table unless you start at our minimum. We won't even discuss it. There's no option. And they just tell you to walk away.
Here's my like read on this is that it's not about the money, right? Like 77% increase versus 50% increase. Like if it was just that, and like they already increased benefits, they already agreed to all this other stuff. If it was just 50 versus 77, they just meet in the middle somewhere with the increase, and like that would be that.
The least important part of this.
The money, it has nothing to do with money at this point. It has to do with the fact that the salaries that these people are making are $81,000. They can make up to $200,000 with overtime. So the problem is that's a decent wage, and if you have to pay these people $81,000, technology is getting to the point where I can implement something that does it a lot cheaper than $81,000 a year. And so the dock workers are saying, shit, like they're seeing this stuff that's getting put in, and our workforce is going to get cut in half. So what they're trying to do, their initial negotiation stance was they wanted zero automation over the next 6 years. They wanted to take the company and handcuff them and say we are banning any automation. So you wanted to upgrade the software on your computer? No, can't do that for the next 6 years. They wanted a complete ban on that. And that's why like I might be a little bit skewed when I'm like seeming like I'm arguing that this is like the union's being ridiculous here, but this is the root of it to me, where like, yes, okay, it's a little bit 77% increase. That's a little bit ridiculous, but in itself, it's like whatever. The whole ban on automation, and you're seeing it in the tech industry too, and you're seeing it like
there's no ban. It's a negotiation. And it blows my mind that you guys seem to have a problem with the fact that we have two sides negotiating and they either come to an agreement or they don't. I know the stakes are high, but the fact that the stakes are high doesn't detract from the fact that both sides have a right to negotiate what's in their best interest.
To me, this is un-American. There's no there's no capitalism involved in this.
That's ridiculous.
Yeah, but Jay, you also know that they know that in the back pocket, if this drags on long enough, the U.S. government has to step in and start making some stuff. So it's not like it's a free market thing.
Absolutely, that's part of the negotiation.
It's not a negotiation. The company is seized. They can't work. It's not a negotiation. It's saying you do what we want or you're going under. That's not a negotiation. So the union is formed to control.
The gun to me isn't to the company's head. The gun is to our heads right now. They're putting the gun to our head because the company, sure, okay, it's billions of dollars a day. That's to the economy. That's not the company. They would get through this. They would work it out. They would, reroute stuff, jack prices up. Like, they're going to be fine. It's going to be us that's getting fucked right now because of this, the fact that this is a monopoly and we've all of a sudden let this happen. It's basically a government system. It's basically a government system, this importing and docks, and it's just not run by the government.
Their benefit pension package that they negotiated. Okay, people show the salaries and they're like, oh yeah, it's the salaries. That package is so astronomically wealthy. There's not an American that gets this stuff. This is like crazy. You're talking about, it is the equivalent of millions of dollars per worker. This is, normal Americans don't get this. So they already are getting high income. They're guaranteed it. But what they're doing, and you're right, they're controlling. This is about power. This is about tightening
blackmail.
Their grips.
It's about leverage. It's about negotiation leverage. This is what I'm hearing.
This isn't why unions were created.
This is what I'm hearing. This is what I'm hearing from you guys. What I'm hearing from you guys is, yeah, negotiation's fine, but if it's really, really important, then it's the government's job to step in and say, we're not going to allow it.
No, that's not what I'm saying at all.
Kyle, you said you're saying this fucks the American people.
Of course it does. And what I'm saying is that the government has somehow allowed this to be a monopolistic industry. And by allowing that, it has created a situation where basically they can put a gun not to the other side's head. This isn't like the auto workers with Ford and GM where they could say, hey, like, you have to do this or we're going to stop making cars. This is saying you have to do this or the economy's fucked.
So all you're saying is it's different because the stakes are higher.
No, it's not the stakes are higher. There's a third party in this negotiation that's not involved. The third party is us.
This isn't a product that's being sold that we have options or opportunities that can go away. This is infrastructure for our country to run.
Should the government be allowed to step in and say, hey, employers, you have to pay them their 77% increase and agree not to automate?
No, they should break up the union, though. Absolutely, they should. They should break up a monopoly. This is a monopoly. They do it. They just did it to Google. They're doing it to Google.
Yeah. They should break up everything. They should break up both sides. We should have, like, if the dock, think of the dock like an airport. There's 4 terminals at an airport. There should be 4 terminals at the dock. They should be owned by all different people. They should have a free market for, okay, you want to come park it and unload at this dock, it's that company. You got to park at this, it's that company. And they have all different unions for all those different companies.
Great. Let's break them up. What do we do for the next 3 years until the government gets around to taking action against them?
You force them to work.
What was that?
You force them to work.
To force them to work for how much? Because the contract expired yesterday.
I think if you just take away I think the union's power to collectively negotiate on behalf of the total workforce of a total industry that is infrastructure is ludicrous.
So tell me what you do.
Do not allow them to collectively bargain for an entire industry.
You're telling me that the government should force them to go back to work for what amount?
No. Not allow them to collectively bargain for an entire industry. An entire industry shouldn't be able to collectively bargain because there are no alternatives. That is a gun to the head. There should be no world in which a union can dictate for an entire industry and infrastructure and tell all of America that we don't care. We're going to get our bag and screw you all. That shouldn't be allowed. The union should 100% be broken up.
How is this shipping and basically our 2/3 of our entire imports by sea, how is that less important than post office? Like the post office workers.
I don't think important has anything to do here. I don't think importance is even a factor. I don't care if these are people negotiating.
Importance is a factor in every decision that the economy, that the government makes. Everything. Is it defense or is it a widget?
I mean, I keep listening to you guys saying how you're terrified that if the wrong people get elected next this election, that we're going to have communism and socialism. Basically, the government's going to take over business.
What are you talking about?
What are you talking about? We never said that.
This is that was the weirdest turn of an argument.
So wait. You guys aren't worried about if the election goes the wrong way that there's going to be socialism in this country. AJ, are you worried about socialism in this country?
I'm worried about on both sides. I'm worried about.
Are you worried about socialism in this country?
Not to the tune of the election. No. And I don't know what this has to do with the election.
What it has to do with is you guys want to give the government the power to tell these people you don't have a contract for working, but you have to go to work.
We're not giving them anything. They already have the power. Biden already has the power.
Kyle, you said that the government should force them to go back to work.
Yes.
They don't have a contract to work. How much are they going to get paid? What benefits are they going to get?
You mediate it. You do the same thing as all these other industries. That's post
what they're
office.
doing, though. They're
mediating outside mediation, and you force them to come to a reasonable agreement. You don't just have both sides.
You mean they negotiate? They negotiate.
No, like don't be obtuse on this. There's a difference. There's a reason that there's a whole industry called mediation, where an outside party comes in. There's no mediation going on right now. There's this side versus this side, and both of them being stubborn and holding a gun to the U.S. economy's
head. That's different than you 5 minutes ago saying you force them to go back to work.
Yes, right now.
But how much do you pay them? What is their next paycheck amount?
Whatever the systems are,
the government should extend the contract.
Jay, stop cutting me off. Whatever the systems are for, there's a mechanism for this. Biden could literally step in and say right now, my government power, you have to go back to work. Whatever that system is in place, the same thing for the post office, same thing for other government workers. Whenever that happens, there's a system in place. You put that in place and then you force them to mediate. It's not like I'm trying to say like, you have to do this. There's already a system and a process involved here. Just implement it.
I think that they shouldn't even be able to collective bargain. I think it's wrong. It makes no sense.
That's a separate discussion of what do you do right now?
Biden takes his powers and he steps in.
Okay, so that gives them 90 days. So he can step in and he can say, you guys have to go back to work for 90 days. What happens over the next 90 days?
You force them into mediation. You bring in a third party.
What's the difference between mediation and negotiation? I'm using the word negotiation. You're
using party. Don't like are like Jay. I know you're smart. Like a negotiation right now is between two parties. A mediation brings in a third party. You know that's what the difference is.
But a third party can't force people to work. They can't force people to go back to work.
No, they force them to negotiate with a mediator. And then if they can't come to agreement, then the third party makes a decision on what they're going to do.
And when the third party makes a decision and the workers say, no, we don't want to do that, then what?
Wait. Okay, let's make sure we get something straight. The mediator does not force anybody to do anything. The mediator is an independent third party who's encouraging two parties to negotiate. They have no power.
You're asking my opinion and what happened. I look at this as this is basically, we've created a situation where this is a pseudo government entity. It is so important to our economy that this is a pseudo government entity to the point where there is a mechanism that the president right now has the ability to force these people to work, to force them to not be able to strike. Biden's choosing not to, but back in 50 years ago, they did force them to work. It's so that to me says this is a pseudo government entity. And in
you know
that
what happened,
case,
but you know what happened 50 years ago after they came to that collective bargaining agreement and everybody agreed? For the next 10 years, the employer hired no dock workers. There were no new dock workers because they didn't like the outcome. And so basically sons of dock workers, people that have been in that industry for generations, could no longer get hired into the industry because they didn't like the results of the negotiation.
And that's because it's a shitty industry. The industry is not set up through capitalist market the way America should work. The way it should work is we should have a free market, and it's not set up right now. It's a monopolistic market. And to AJ's point, yes, Jay, in the short term, we can argue about, okay, how do we get there? How do we do this? But in the long term, they have to break it up. They got to make this no longer be a monopoly.
By the way, guys, something definitely needs to change because, like, again, from my experience, and this was 20 years ago, it was such an inefficient system. Like, literally people with clipboards hanging around. This was 20 years ago when they're like, the technology isn't even what it is today. Literally the most efficient thing with people on clipboards. Right now, the largest, I would say that the highest paid longshoremen or dock workers are crane operators. You have AI now that could easily not easily, there's a price to it, but they can automate that very dangerous job of crane operator. They can have a computer and AI powered machine that they use in other countries to actually get those containers off the ships. And you would literally eliminate the need to have a crane operator. But of course, the unions are protecting the crane operators, they're protecting the dock workers. They don't want to lose half the workforce, even though that would be the best from an efficiency standpoint and from a GDP growth, from a market perspective, would be helpful. This is, if the country, these policies, again, whether how you fix it, I don't know, but the reality is that it's just a very inefficient, having somebody have to shadow you just because there's a contract involved. Can you imagine if the union forced us to have 4 other co-hosts of the podcast? So there's actually 8 of us instead of 4 because there was a contract involved. So the 8 of us had to be co-hosting the podcast, even though the 4 of us are the only ones talking. That's the kind of ludicrousness that's happening right there because of the way the system is set up. And the automation.
Jay, you're arguing this. Like this is a contract negotiation between 2 independent parties. Like, okay, Jay and I we want to negotiate a partnership between us. If we don't negotiate that partnership, then you go to a different partner and I go to a different partner. That's the way a normal contract negotiation happens. That's not this situation. There's no other partners. There's only 2 people because it's a monopoly on both sides. So it's not a negotiation.
It already happened. The United States already took care of this exact similar thing. The railroads had the similar problem. So the railroads were all being controlled. And you know what happened? They literally stopped shipping products to certain places. And the government stepped in and said, that doesn't work. You guys can't own all the railroads and just start shipping products one way. And so you can increase your freights at another spot. So they broke the railroads up. They said, stop it. Now, today, we have a bunch of different railroads, and the collecting bargaining even there is so screwy that the unions have done and how they're killing the railroads.
Yeah, and how's the railroad industry doing?
It's just these unions kill these things. They just kill them.
Kyle, you were, I assume you were a member of the National Hockey League Player Association union.
Yes.
Okay. And so how would you have felt if your union were negotiating and because you thought you deserved better working conditions? Just listen to me out.
I'm so glad you brought this up. You know what happens? So if there's a contract dispute and this person, because there's restricted agent, whatever, but they're all the time, there's a contract dispute. The team wants to pay this much, the player wants this much, but there's a restricted status, so the player can't just leave an unrestricted free agency. You know,
I'm not talking about individual players. I'm talking about the union negotiating with the league.
But do you know what the NHLPA and the NHL agree to in a case where there's a dispute between a club and a player? You know what happens? They go to mediation, and you know what happens in mediation? The mediator takes both sides and comes to an independent decision that is binding for both sides.
Step back. What did you say? You said the club and the union agreed to that mediator thing?
It's in the contract.
It's in the contract. So they negotiated it.
Right.
So it wasn't you sitting here on a podcast saying this is the way it should work. It was part of that negotiation, which is the way it should be. All of these terms should be part of that negotiation.
Keep bringing that up. This isn't a negotiation. This is a negotiation implies that there's 2 independent parties and they have other options. There's no other options. This is a fucking Mexican standoff.
The reason why that worked is because Kyle, in his industry, had options. They could go do other things. This doesn't exist. This is an infrastructure where you have 2 parties that control all of it. All of it. There is no other people. There's no other options.
It's the exact same way in the NHL. If you guys don't, if the 2 sides don't come to an agreement, you don't have hockey. Auto workers. If the 2 sides don't come to the agreement, you don't build cars.
Yeah, but it's a negotiation between the other side because it doesn't affect the U.S. economy.
So now we've gone back to the point why this is different because it's more important.
No. It's not. It's because the other ones I have options.
AJ, just admit it so Jay could feel like he got his win. Yes, it's more important.
Can we get to the top 10?
I don't even know what Jay's argument is right now. Like, I feel like he's just arguing with us because he likes arguing.
I'm arguing for capitalism. I'm arguing for the government shouldn't be allowed.
This is anti-capitalism. Like, this is.
No,
this
you're
is
telling me the government should be able to step in, or a mediator should be able to step in and determine what somebody's going to work for.
Jay, where you're missing the point is, I think the point is that the only reason we're in this mess in the first place is because of government intervention. If you didn't have the government intervention in the first place, you wouldn't be in this mess.
It's an anti-capitalistic industry.
Well, we've already had our discussion on unions in general, and you had a chance to say unions in general shouldn't be allowed. You guys didn't say that on the last episode.
Because I do believe unions were created to make sure that workers have good working conditions, are treated fairly, all these different things. They're not to basically put a gun to the U.S. economy's head and say, hey, give us what we want, or we're going to shut down the economy.
So again, this is different because it involves the U.S. economy.
No, it's because it's a monopoly, Jay.
Exactly.
How is that different than the United Auto Workers? How's that different than the
It's not
Teamsters?
a monopoly. The United Auto Workers is not a monopoly.
How is that not a monopoly?
I can buy cars from anyone, from anywhere. I can't all of a sudden say, oh, the dock workers don't want a dock. I'm going to open up a dock in some other random city that has no infrastructure.
There are 1,300 docks. 64 of them are controlled by this union. There's another 1,200 docks.
But not at the locations they're at. So this is like saying.
So this is different.
Do you think those other 1,300 docks can support a 16,000 tanker?
It doesn't matter. It's in a different location. If I've got to dock at one place to get my products there, I don't go, oh, well, I can't do it in Texas now. It's okay. I'm just going to go over to Seattle.
Okay.
What?
Let's move on, and because we didn't get to the important part here, which is how is this likely to impact the economy? Do we want to talk about that?
Wait, that's it. We're moving on to the top 10. Are you kidding me? That's it. You used up all your time to discuss these issues. Let's move into the top 10. So let's go to the top 10, Kyle.
Do we not want to talk about how it's going to impact our economy?
To just briefly say it, I agree 100% with you, Jay. This could be one of the most devastating things our economy has ever seen if this doesn't get involved. I'm 100%.
How many days? Okay, here's I'll hit each of you with a question then, and I feel like this will wrap it up well. How many days does this go on before Biden steps in and he enacts his presidential power, put him back to work?
When does Biden wake up? Tell me that.
Well, put it this way: if he does that, Republicans are going to complain because that basically
because it's Biden. So politicians will complain always.
They're going to say it's anti-union.
No. What they're going to say is that it's election. What Trump will say is it's election interference because he's trying to get the economy to keep going until after the election. So I actually think it's pretty bold of Biden to say, "Look, I'm willing to risk the economy, which means I'm willing to risk my side winning the next election because I want to stand up for workers."
I think that'll change the moment it starts to affect.
That's the point. Is Biden's obviously hoping they'll just figure their shit out in the next week or so, and so he has no political blowback or whatever. But that's my question was like, how long does he let it go before he steps in?
The moment it starts affecting voters is the moment they will jump in.
Then we're back here having the same conversation in 90 days.
Do you think so basically, AJ, your position is he's going to wait until there's basically politically so many people are crying for him to step in that he steps in and he's the white knight.
Wait a second. Hold on a second. Wait a second. But if you wait 90 days, guess what happens? We have an election. The election comes and goes.
Yeah, that's why I think it's if it gets to a point where voters are affected and they start to blow back, or it looks like he'll jump in.
What do you think? A week?
I'd say 30 days.
Okay, so let's talk about the timeline here. So in the first couple of days, we're not going to see a lot of things change. So there are some things.
First of all, let me disagree with that right off the bat. The Rauld family is already stocking up and has been buying all kinds of stuff, toilet paper. We were stocking up.
All your stuff's coming in on the West Coast. This is only East Coast.
What about bananas, Mauricio? Bananas come in right down the street from me, and Dole has their import.
I'm stocking up on clear rum to make sure I don't run out of any of that.
Let me
American
try and
made, baby. You don't have to worry about it.
let me try and get through this. First couple days, we're going to see an impact on things like bananas, the perishable stuff.
Eggs. Do we have an impact on eggs?
No impact on eggs. Eggs are all domestic. Most of our food is domestic.
We get our eggs from AJ's coop in his backyard.
The one nice thing is, whatever happens in the global economy, the vast majority of our food comes domestically, and so.
And I know most people are worried. 79. There's good news. 79% of the beer consumed in this country is domestically made. So don't worry. Beer is going to be fine.
Jay, the time frame real quick here. How does this work with the port workers? Inventory stuff coming? Yeah,
that's actually the bigger question. That's the bigger issue. For the first couple weeks, there's not a lot of impact on the four of us and regular Americans out there. Yeah, you might not get as much. Your coffee might go up in price. Your bananas might go up in price, whatever. Who it really hits is there's a bunch of tens of thousands of ancillary port workers that it's going to hit. All of these port towns that rely on their economy relies on these ports and the people working in these ports. Those small towns are going to take a hit. The two big industries that are going to take a really big hit within the first week or two are transportation truckers. So truckers aren't going to have anywhere to drive all of this inventory. They're not going to be able to go to the docks, load up their trucks, and then drive to the warehouses. And the second piece is the warehouses. So all the people working in the warehouses that are stocking this inventory. So we're going to have about 100,000 people that are impacted. Their jobs are impacted, which is about twice as many people as are actually on strike. So in addition to the 45, 46, 47,000 people on strike, we're going to have about 100,000 people whose jobs are impacted in the first week or two. After the first week or two, that's when we start to see a lot of issues. Basically, most big companies that have non-perishable stuff, think auto part companies and commodity suppliers, things like that. They've got enough stuff on their shelves for a few weeks, maybe even a month or two or three. But after a few weeks or a month, those shelves start to go empty, and now these businesses are not making as much money. The businesses start laying people off. The prices of things start going through the roof. Probably in about 3 to 4 weeks, we could see the impact being somewhere around $4 to $7 billion per week. If you think about that, that is about 0.1% of GDP per month. So if this goes on, let's say 3 months, we're literally going to see 0.3% of GDP drop, which is significant. Now, the interesting thing there is,
but that's not also the correlation to what it affects. Like that, it's a cascading effect on the economy.
Oh yeah, it's going to be unemployment. It's going to be GDP reduction. It's going to be significant inflation. It's going to be basically, this is going to lead into the next. We're all wondering what the cause of the next recession is. If this thing lasts a month, this is the cause of the next recession.
We're gonna do a top 10. We're gonna sneak this in. We talked a little bit about like what imports would be affected. So I thought it'd be interesting because I was like, how many things are coming in that are being imported that will actually see these downstream effects. So I thought I'd go through the top 10 imports in the U.S. And it's funny when you look at the top 10 imports and the top 10 exports. The crossover, there's like 7 of the 10 are on both lists, which is super weird. But anyway, top 10, number 10, gems and precious metals. Random. Plastics is number 9. So plastics, actually, that's a lot goes through Houston with the petroleum and all that stuff. Then we have furniture, lighting, and signs, medical equipment and supplies. Obviously, food and live animals are on there. Pharmaceuticals is up there. Minerals, fuels, and oils. Vehicles and automobiles, then electrical machinery, and then machinery, including computers and hardware, is number 1, just edging out electrical machinery. And if you actually go look at the top 10 exports, those are all kind of the same. They're just in different orders: machinery, vehicles, even fuels and oils. It's funny how the U.S. economy works, where we import some of the same shit as we export. So there's your top 10. No comments, Mauricio? You're just done with this podcast, eh?
I'm done. I'm moving on.
Okay. All right, let's do something fun then. Let's wrap it up with something fun. There's a debate on the internet. I like doing debates on the internet. And this is super random, but I thought it was interesting when I heard people actually had different perspectives on this. It's one of these things that I thought everyone did the same thing. When you are getting dressed and you're putting on shoes, how do you put on your socks and shoes? I'll give you an example. My socks, I put my left sock on, then my right sock on, then I put my left shoe on, then I put my right shoe on, and then I tie my right shoe and then tie my left shoe. Apparently there's people out there that will go left sock, left shoe, left tie, and then do the whole process on the other side. And I want to nip this in the bud, and I want to make sure that I'm in the right. So Jay, how do you put on your socks and shoes?
I slide my foot into the right one first and then the left one second.
What about your socks? If you have to put on socks and shoes.
Oh, shoes. I only wear flip-flops.
You've never put on a pair of shoes.
Let me give you the right answer. Let me just give you the right answer. So what you have to do with the way it works when you're patenting this stuff is you put your one sock on, the next sock on, then one shoe on, then the next shoe on, then you tie one shoe and you tie the other one. That's how it. That
is not how I do it. So how I do it, I open up my socks, I look at the toe, and I see if I have a left. You asked me, I'm telling you. Don't give me that look. I see if I have a left sock or a right sock. If I have a left sock in my hand, then I put it on my left, and then I put the right one on. If I have a right sock in my hand, then I put the right one on first, and then the left one.
Okay, so the point is you put your two socks on first, both socks.
Yeah, but you said you put left on first, right second. Me, it changes. Then I put my left shoe on first. I tie it, and my right shoe on second, and I tie it.
So you go sock, sock, shoe, tie, shoe, tie.
Correct.
And Mauricio and I go sock, sock, shoe, shoe, tie, tie.
That's the way it's supposed to happen. If you just look at the way the government has told us how to do it, that is the way you do it.
Sock, sock, shoe, shoe, tie, tie. So AJ, are you sock, sock, shoe, tie, shoe, tie?
Socks, shoes.
When do you tie them though?
I zip them up. They're boots.
Okay, so when do you zip them? So do you put one on and then zip it up, and then put the other one and zip it up?
No, I put it on and zip it up.
His assistant number 17 puts the left one on. Assistant number 18 puts the right one on. Assistant number 44 zips them both up at the same time.
But what I want to know is, does AJ board the private plane before he puts on the shoes or after he puts on the shoes? That's what I want to know.
No, AJ does the J thing where he wears flip-flops onto the plane, and once he gets on the plane, then somebody's on there with his shoes and his socks, and they put them on for him, put his shoes on, tie them up, so then when he gets there, he's ready to go wherever he has to go.
If only my life was as amazing as you guys think it is.
AJ shows up in a robe and flip-flops to the plane, and then they dress him when he's on there. All right, plugs. I'm mad at Jay. So Mauricio, what you got?
I am such a crotchety old man right now.
I'll skip it. Just go. I'll promote AJ's book.
AJ, you going to promote Mauricio's book?
You know what? I will promote my Instagram just because I've never done that. AJ Osborne, go on to Instagram. Check out what we're posting.
Watch out for all his fakes. There's a lot of fake AJ Osbornes. People apparently try to be AJ. You're very fakeable. All right, Jay, just because whatever you plug usually benefits me monetarily. Just
dredaily.com. That's our daily economics newsletter. Talked about the strike a little bit today. I'll probably talk about it tomorrow also. dredaily.com. Sign up for our daily economics newsletter. The most important 3 minutes of your day.
Once again, I'm going to go plug my wife. Special shout out. Go check out Badass Investor. Follow her this week because we will be in Cancun. 3 of us at least, unless AJ 4 wants to just jump on his plane and come out and meet us. I don't know. Maybe you'll catch a shot of Jay or Mauricio with his shirt off or something on a reel, on an Instagram reel from Ashley. You never know. You could just you got to follow her to see. She's we're gonna be at the beach. She's gonna be snapping reels. So you never know what you're gonna get. All right. My drink has been gone for a long time. I chugged it right at the end of that argument. So I gotta go hit the head. I gotta piss really bad. So I don't know if I'll see you next Tuesday, but I'm going to send it anyway. I'll see you next Tuesday.
I love you guys. You're awesome.
Love you
Love ya.
guys.